Welcome to Talk Tickers. Today, we're diving into Algoma Steel, ticker ASTL. Now, this is a company caught between some absolutely crippling U.S. tariffs on one side and a really bold plan for survival on the other. Their latest earnings report? It was a mess of contradictions, so let's break down what's really going on here. So, Algoma reported their earnings on October 30th, and, well, to put it lightly, the market absolutely hated it. The reaction was fast, it was brutal, and it was a really clear sign that investors were spooked by what they saw in the numbers. And here's what that looked like in real time. The stock just plunged over 6% on the day of the call. It closed just under $4 a share and on a huge spike in trading volume too. So what on earth happened to cause this kind of panic? Well, this is where things start to get really confusing. See, Algoma actually beat on their revenue expectations, which, is normally a good thing. But at the exact same time, they posted this colossal miss on their GAAP earnings per share. These are the kinds of contradictory signals that just scare investors away. So what's behind this massive loss, right? Well, the key thing you got to understand is that it wasn't from them just burning through cash. The entire loss was driven by a huge $503 million non-cash accounting charge. In fact, if you strip that out and look at their adjusted numbers, they actually beat expectations. It just created this really murky picture of their true performance. But, okay, let's cut through all that accounting noise. If you want to know how the actual operations are doing, the best number to look at is adjusted EBITDA, and that came in at a loss of 87 million Canadian dollars. This number, right here, tells the real story. The company is under some serious operational pressure. So you might be asking, where is all this pressure coming from? According to management, it really boils down to two things. Triage, to stop the financial bleeding, and this massive, and I mean forced strategic transition. And the main villain in this whole drama? It's the 50% Section 232 tariff that the United States put in place. Management says this one single policy has effectively crippled their entire historical business model, which, for years, was built on selling steel right across the border. And if you want to put a number on just how much damage this is doing, get this. In the third quarter alone, these tariffs cost Algoma nearly 90 million Canadian dollars. To be clear, that is more than their entire underlying operational loss for the quarter. Yeah, and the outgoing CEO, Michael Garcia, he didn't pull any punches. He basically said the U.S. market is, for all intents and purposes, closed to them now. And that's forcing a complete top-to-bottom overhaul of their strategy. It's just a massive external shock to their system. Okay, so their main market is basically gone. What do you do now? How does a company like Algoma even survive this? Well, they're not just sitting on their hands. They've laid out this really clear three-step plan for survival that's meant to completely reposition the company for the future. First things first, you gotta stop the bleeding. So, step one is triage, shore up the balance sheet. And they've done that by securing a $500 million liquidity package from the Canadian and Ontario governments. This is an absolutely critical lifeline that buys them time to make this transition happen. Step two is all about the transition. They are full steam ahead on shifting away from these old kind of dirty blast furnaces to modern super efficient electric arc furnaces, or EAFs. This is the real technological core of their turnaround, and the milestone everyone is watching is mid-November. That's when they're targeting a ramp-up to 5-day-a-week operations. And that brings us to step three, the big pivot. The new strategy is to stop trying to compete in this commoditized global market and instead completely dominate a niche where they have a huge advantage, becoming Canada's only domestic producer of steel plate, which is a much higher value product. You might wonder, why such a dramatic pivot? The truth is, it's not really a choice. It's a move they have to make to survive. And a quick look at how they're performing against the rest of the industry makes that painfully clear. I mean, just look at this chart. Over the past year, Algoma stock has gotten absolutely crushed, down almost 67%. But the rest of the steel sector, which we're showing here with the SLX Steel ETF, is actually up. So this makes it crystal clear. This isn't an industry-wide problem, this is an Algoma-specific problem. So, faced with this reality, management is basically trying to sell a whole new story to investors. They want to reposition Algoma as an absolutely essential supplier for Canada's future. We're talking defense, infrastructure, big energy projects, a strategic national asset. And this, right here, is the multi-billion-dollar question for anyone looking at this stock. The entire Canadian market for steel plate right now is only about 600 to 700,000 tons a year. So is that really big enough to support Algoma's massive new production capacity? So the bet they're making, and it is a big bet, is that while today's market is just too small, a whole wave of future government-led projects, think shipbuilding, new infrastructure, defense spending, that all that is going to create the demand they need for this bold strategy to actually pay off. Okay, so the board is set, the pieces are moving. Let's get to our take on this whole thing. Here's what we're going to be watching for next quarter and how we see the trade setting up. As we look ahead, there are really 4 key things, 4 catalysts that are going to drive this stock. First, that mid-November EAF ramp-up. Did they hit their target, yes or no? Second, any news on them drawing down those government funds. Third, any positive news, any relief at all on the tariff front. And finally, and maybe most importantly, any sign that their cash burn is finally starting to stabilize. Now, for their next earnings call, honestly, we expect the headline numbers to still look pretty ugly. But here's the thing. We think the market is going to look straight past the reported EPS. All eyes will be on one single metric, the EBITAF utilization rate. That's going to be the only number that matters. So, with all that in mind, we are making a bit of a contrarian call here. For the next call, we are rating Algoma Steel outperform. This is a bet on the pivot. It's a bet on their survival. And our thinking on this is pretty straightforward. First, the stock is currently priced for bankruptcy, not for a successful transformation. Second, that $500 million government backstop is a massive safety net that we think the market is underappreciating. And third, if they can actually pull off this EAF ramp-up, it will fundamentally de-risk the entire story, and that potential upside is just not in the stock price today. This is not financial advice.